Thank you, Lud. I'm Doug Jones, and I've been with Fahrenheit Advisors for 9 years, doing fractional and consulting chief financial officer work with small and middle market companies. I have clients in real estate and construction, professional services, distribution, and manufacturing. Before that, I was a chief financial officer for 25 years with middle market companies. And before that, worked for some Fortune 500 companies. So I have both big and small company experience. I will start by saying I have way too much material, so I might speak a little quickly. And Jay, you'll have to pull a hook out if I go too long. The saying for today is cash is king. Obviously, we've heard this before, but now it's true more than ever. Lack of cash or availability to cash is the one thing that can put the company out of business quicker than anything. I have a few quick ideas to help you. Some of these you'll hear from other speakers as well. Number one, if you haven't started already, you must start building a 90-day cash flow forecast. And I know there'll be a lot of guesstimating and it'll have to be adjusted over time, but it's better to start with something rather than nothing. So that's the number one priority that I would like to see everybody be working on if they're not working that already. Eventually, you may need to go longer than that, but 90 days is the start right now. Number two is some things to think about as you're looking at cash and cash flow. Some obvious, some not so obvious. Accounts receivable is the big source of cash for most companies. And remember, your customers and clients are trying to hold on to cash just as badly as you're trying to hold on to your cash. So you need to take a quick look at your age trial balance. And you're probably used to going after your delinquent customers and clients and chasing them for money. You, of course, need to do that. But I would suggest that you also look at folks who are current and owe you money coming up soon. As I said before, they're going to be looking for ways to slow down their payments. So you want to make a call to each one of them and make sure that everything is in place for them to make a prompt payment to you. This will be the time when you start hearing excuses like, oh, we need a copy of that invoice. Oh, we need your insurance certificate. We need the delivery receipt, whatever it is to slow things down. You want to learn about those objections now rather than waiting till the day the invoice is due and you say, what happened 10 days later? And then they start asking for what it is that they need. So get in front of that process right now. You also want to carefully consider new extensions of credit. We used to say the sale isn't complete until it's collected. You may have to make some difficult decisions about who you extend credit to. And certainly if you're doing any kind of custom work for anybody, you should be asking for some sort of deposit. Other little things to look at, deposits on your books. You may have made deposits on equipment that you don't need now. You may have made deposits on a trip or conference that you're not going to do now. Make sure somebody's working on getting all of that money back into your coffers at this point. Lines of credit we're going to talk about also. Chip's going to talk a little bit about relations with your financing partners. I'll be talking about the various SBA loans. But if you have a line of credit in place right now, you want to make sure you're talking to your banker and having an honest conversation with them about where you are and what your potential needs will be for the future. That's the cash inside. On the cash outside, payroll is obviously a very big outflow for folks. And I can't stress enough how important it is to pay employees and their payroll taxes in a timely manner. Many of you know that not paying those is a quick way to end up in jail. There have been some ugly situations where company officers have been penalized for not paying payroll taxes. I know there are some extensions for paying payroll taxes at this point, but you need to make sure that you're paying your people and payroll taxes in a timely manner. Accounts payables, the other big source of cash outflows. Now the shoe's on the other foot. You want to be the one to slow down cash going out the door. And there's no shame in being a little bit of a stickler for details. You don't have the right copy of the invoice or delivery ticket or insurance certificate or whatever it is that you're looking for. You can ask for those things before you release payment. I would also suggest that folks formalize their process in terms of what payments are going out the door. Now is not the time for you to be relying on your accounts payable clerk to decide what's paid and what's not. First thing I would do is I would slow down or reduce the number of check runs that you're doing. Some people are paying people every day. I would cut that back to once a week and make sure you're having a management discussion over what gets paid and what doesn't in what order. Then another thing, and this is a little tricky, but if you have a lot of ACH payments where money is coming out of your account automatically, some of those are contractual and your vendor is giving you a certain price deal because you're going to pay them by ACH. And those you can't just change without talking to your trade partner. But if you've done some of these for convenience, just to make it easier, you might want to take those off of ACH so you can control when those items are paid rather than having your partner decide when those are due. The other outflow, debt payments and rent. Again, communication, we've talked about this and we'll talk about it 100 times. You should be talking to your lenders, you should be talking to your landlords about possible payment holidays or deferrals or extended terms. Some will say no, some will say yes. Whether your landlord says no or not will probably depend on whether he's gotten some room from his bank or other lender to slow down on payments, but it can't hurt to ask. Third section I want to talk about is the recent government actions to help everybody through the rough patch. And I will tell you, when I started this presentation last Friday, I figured I was going to have a nice, neat presentation on the new loan programs that are out there, but the ink is still drying. Additional regulations have to be issued by the IRS, the Department of Labor, and the SBA to implement some of these, so there are very few final answers. There's also a lot of misinformation floating around, based on draft versions of the law, or just plain bad interpretations, or especially in the popular press, oversimplified interpretations. So my rule is I don't believe something unless I've seen it 2 or 3 times from 2 or 3 different sources, because I've gone down the wrong road on a couple of these things over the weekend, only to find out some other folks were mistaken. Couple things in the legislation. Remember, the legislation is intended to help employers keep people on board. But if they can't do that, there is enhanced unemployment. I think most folks know now that unemployed workers can get an additional $600 per week above their state benefits for unemployment anytime between January 27th and 31st. It's our understanding that partially unemployed people whose hours have been cut, will get a pro rata piece of that 600. So as you have to lay off or furlough or reduce hours of employees, it's important that you let them know of that benefit, and they should be applying as soon as they possibly can. In terms of the programs to keep people on the payroll, there are actually several. There's one schedule change, one incentive, and 2 types of SBA loans. The schedule change is the delay of employee portion of employer taxes. For 2020, you can actually pay those employer taxes in 2021 and 2022. That benefit, however, isn't available if you take one of the SBA 7A loans that we're going to talk about in a minute. The other incentive is the employee retention credit. You also cannot take advantage of this if you get an SBA 7A loan and are getting debt forgiveness. That's a credit against your payroll tax, 50% of wages up to $10,000 per employee. And there's some specifics about who applies and who will be able to take advantage of that, and we need to read the fine print for those. Then there are 2 loan programs. The first one is the Economic Injured Disaster Loan, which is up to $2 million. We are hearing, though it's not yet in official writing, we are hearing that the limit is going to be based on 6 months of a company's operating expenses. That will be the max that you'll be able to borrow, up to $2 million. Interest rate is going to be 3.75 for terms up to 30 years. There'll be no personal guarantee required up to the first $200,000, and any available assets will act as collateral. The EIDL is applied for directly with the SBA, not through a bank. So you actually need to go on the SBA website. Our understanding is that the process for applying has gotten easier over the last week. It was pretty burdensome, but I've had 2 cases this week where it's been a lot easier for folks, so that's good. The other loan program is being called the Paycheck Protection Loan. This is the one that everybody's talking about because this is the one that supposedly has debt forgiveness capabilities, and it does, subject to some limitations. This is a loan that is a maximum of 10 million, the lesser of 10 million, or 2.5 times the average monthly payroll based on your last year. So if your monthly payroll was 100,000, you could borrow 250,000. Rate is not to exceed 4%, 10-year term. And since this is part of the SBA 7A program, it will be administered by banks, not directly to the SBA. A little heads up there, the progress on this will be frustratingly slow. Under the law, the SBA has 2 weeks to come up with the implementing regs. You can use the funds under this loan for salaries and wages, healthcare benefits, mortgage interest, rents, utilities, and interest on existing debt. And the good news about this one is there will be no personal guarantee, and no collateral. The potential loan forgiveness comes in, and this is where I get everyone's attention. And this is also, by the way, where your employees are hearing not totally correctly that, oh, the government's paying my salary for the next 8 weeks. That's not 100% true. The forgiveness is, in fact, for up to 8 weeks of the eligible expenditures, but it's reduced in 2 ways. And they're a little bit complicated, so I won't go through all the math, but if you have a reduction in full-time equivalent employees over some base period, which is very often the prior year, there'll be a proportionate reduction in your debt forgiveness. So if you cut your payroll by 1/3, your debt reduction would be cut by 1/3. There also can be a cut in the case you reduce employees' salary, individual employees' salaries by greater than 25% over the last quarter. That will reduce the debt forgiveness as well. So it's not a free lunch. You have to comply with some things. In some industries, it will be very hard to comply with those because you've already laid off a lot of people. It does give you the ability to bring those folks back and still fall in under this loan, but that I don't think is going to make sense for a lot of businesses. My thinking has evolved over this over the last week or so, last weekend. As a finance guy, I was really focused on the debt forgiveness. How can we maximize debt forgiveness? And in fact, that's important, but at the end of the day, you're going to probably have fewer people than you had during the base period, either last year or early this year. That's just a reality of business at this point. So if you in fact lay people off and they're able to get the enhanced unemployment benefit and you get some of your loan not forgiven, what do you have? You have a 7A loan with a 4% interest rate, 10-year amortization, no personal guarantee, and no collateral. Doesn't sound like a bad way to go. So I'm thinking most folks will be interested in that 7A program. So bottom line, since it's going to be done through banks, I would let your banker know as soon as possible you'll be interested in that 7A. And right hot off the presses, I heard just an hour before we got on this call, I heard that there may be the possibility for people to apply for the SBA loan, the emergency disaster loan, and ultimately convert it into the 7A loan. I can't say that's for sure, but if that's the case, if we find that to be the case, then I'm going to suggest that everybody go and apply for the disaster loan because they can convert it later. Disaster loan will work for some people. That's a facts and circumstances thing. We'll need to look at people's specific cases on. Then on the other hand, just to show you the kind of information that's floating around. So I heard that this was going to be something you'd run through the SBA while they were working out the arrangements for the bank. And from another source, I heard that the SBA is going to come out with their forms and guidance in the next 3 days. So we really don't know, and we're just going to have to stay on top of that. But clearly make your banker aware you're interested in 7A, and we'll keep on top of what new rules and regulations are out there.